In the previous session, we examined the structural characteristics of the Seoul Living Sector. We identified three key dynamics: strong demand, supply shortage, and a shift in ownership from individual investor to institutions. In this session, we will look at the macroeconomic conditions and policies that shape the Seoul Living Sector. Through session 1, we have seen the structural opportunities in Seoul's rental market, which is why overseas pension fund and institutional investors are looking for investment opportunities in Seoul. However, there are regulatory challenges tied to the macro environment, and that's what we will cover in section 2. This is the image showing all assets run by professional operators in Seoul. Most of these assets have been delivered between 2022 and 2025. Seoul has about 1.75 million single-person households, roughly 40% of all households. But professionally managed rental units stand at only 89 assets. It's about 7,300 units. That's less than 0.5 units per 10,000 single-person household. The vast majority of residents still rely on the individual landlord market with limited management services. Over the past several years, many global institutional investors have entered Seoul's residential market. However, they are reluctant to invest the asset now due to the regulation uncertainty. Two measures introduced in the second half of 2025 have shifted underwriting assumption across the board. A heavier property tax burden on rental holdings and tighter limits on rental housing lending. As a result, many platforms have paused new deployment pending reassessment, and global capture is now sitting on the sideline, waiting for policy clarity. Now let me walk you through Korea's macro. Over the next several slides, the goal is not just to show you economic data, it's to answer one specific question. Why is Seoul's institutional rental market slow to mature now, even though the structural opportunity is so compelling? Let's start with the policy rate. Korea sits at 2.5%, which is 125 basis points below the US at 3.75%. Japan is still ultra loose at 0.75%. Australia is tightening at 4.1%. Korea sits in the middle of APEC stack, but with the least room to move. Here's an important context. Korea has historically kept its policy rate above the US rate to prevent capital outflow. The only exception have been brief crisis period, the dot-com bubble, 2008 financial crisis, and COVID. But the current inversion has now lasted over 14 months with no crisis triggered, and the one Korean currency has been anchored above 1,400 and now over 1,500. There are several reasons behind this, but one of the major issues is household debt. Korean household debt sit at nearly 90% of GDP, already among the highest in the OECD. But the official number understates the real picture because it excludes 전세 deposit. Once you include 전세, Korea's household debt to GDP ratio is closer to 145%, the highest in the OECD by a wide margin. Despite all the macro pressure we have just discussed, Korea's economy has remained stable, and the region is export. Korea has run a current account surplus every year since 2012, and despite the rate inversion, the surplus has widened to record territory in 2024 to 26, driven by semiconductor strength. Exports are absorbing the FX pressure. Korea runs a current account surplus, and the surplus accumulates into FX reserve, now around 400 billion US dollars, which is top 10 globally. These reserves are the dollar buffer that supports the Korean currency. The chart shows more than the level, it shows the consistency. Through the 2008 financial crisis, COVID in 2020, reserve declined temporarily but did not break the long-term upward trend and recovered within a few quarters. Korea's macro is in a strong place. AI-driven semiconductor exports are at a record level. The current account surplus has widened, and FX reserves sit at 427 billion US dollars. The external account is solid, but underneath, the government sees two structural problems: household debt and rising apartment prices. And its answer has been to come down hard on multi-home owners. Korea's rental housing legislation was designed to formalize individual multi-home owners, not to accommodate institutional capital. Because of that original design, policies aimed at curbing speculative multi-home ownership also apply indiscriminately to corporate rental operators. The same measures aimed at speculators are being applied to corporate rental operators. In the second half of 2025, the property tax aggregation exemption was removed, and lending against rental housings was curbed. Institutional capital takes two paths: acquire to rent and build to rent. Today, both face meaningful constraints. For acquire to rent, two regulations took effect at once. The property tax exemption was stripped and acquisition lending was shut down. The leverage that scaled the portfolio from 2018 to 2025 is no longer available. Build to rent keeps its tax and financing incentive, but land is expensive and construction costs are up 30% since 2021, and rent increases are capped at 5%. Add a 10-year lockup, and IRR sits below institutional threshold. Here's the takeaway: the standard tracks are constrained today, but that is precisely what makes today's entry point asymmetry. The bidder field is thin, the niche remains open, and the investment platform you build now will compound when policy normalized. In this session, we examine the macroeconomic environment of the Seoul Living sector. In the next section, session 3, we will explore where institutional investors can find opportunities, looking at specific strategies and the concrete investment opportunities available.